Choosing the right business entity is one of the most important decisions you will make as a business owner. The entity you choose will affect the way how you run your business and what rules you need to follow. Let's go over the most common business entities and compare them, so you can see how each one can affect your payroll, taxes, and compliance, both at the federal level and here in California. Sole proprietorship. To start this entity, you don't need to file any forms with the state. You simply reply your business income and expenses on your individual federal tax return Form 1040 under Section Schedule C. The net profit on Schedule C is subject to the 15.3% self-employment tax. Since there is no legal separation between you and your business, your personal assets are not protected. There is no payroll for the owners, but you can hire employees. In California, you simply file your individual state tax return, Form 540. Limited Liability Company, or LLC. You form this entity by filing articles of organization with the California Secretary of State. A limited liability company provides personal asset protection as long as you keep your personal and business finances separate. If you are the sole owner, it is a single-member LLC. If there are two or more owners, it's multi-member LLC. By default, for payroll and tax purposes, a single-member LLC is treated as sole proprietorship and multi-member LLC as partnership. You can also elect to be taxed as a C corporation or S corporation. I will go over partnership, S corporation, and C corporation later in this video. In California, you file Form 568 and pay $800 minimum LLC tax. If your California gross revenue is $250,000 and more, you pay additional LLC fees. Partnership. There are two types of partnerships: general partnership and limited partnership. A general partnership can exist without any state filings, but limited partnership needs to be registered with the California Secretary of State. Personal asset protection applies only to limited partnerships or LLPs. There's no payroll for the partners, but if you hire employees, payroll is required. Partnership files federal tax return Form 1065 and don't pay any income taxes at the entity level. Instead, the net business income passes to the partners through Schedule K-1. In California, partnership files Form 565 and pay the $800 minimum tax. There is no additional LLC fees apply. C Corporation. You start a corporation by filing articles of incorporation with the California Secretary of State. Unless you elect S corporation status, it is taxed as a C corporation by default. Corporations provide personal asset protection by separating personal and business liabilities. Payroll is required for the owners, and you need to take a reasonable W-2 salary through payroll. Corporations file federal tax return Form 1120 and pay 21 corporate tax on the profit. Profit can stay with the company or to be distributed to the owners. We call them shareholders as dividends. Paying dividends causes double taxation, first at a corporate level and then as a personal income to shareholders. In California, C corporations file Form 100 and pay the greater of 8.84% of net income or $800 minimum franchise tax. S corporation. An S corporation is not a separate entity type. It is a tax status that you elect for a corporation or limited liability company by filing IRS Form 2553. Personal asset protection and owner's salary requirements are the same as a C corporation. S corporations file federal tax return Form 1120S and don't pay any federal income tax at the entity level. Instead, the net business income passes to the shareholders through Schedule K-1. Shareholders can also take distributions in addition to the salary. These distributions generally are not taxed under certain conditions. In California, S corporations file Form 100S and pay the greater of 1.5% of net income or $800 minimum franchise tax.